Hi, it's Brad with Ocean Consulting Services with the next in our series on IRS collections. Today we'll be talking about property liens, who gets paid first. Let's start off with some highlights. With tax debts, the IRS obtains a lien on all property. So the question that comes up is, what about my other debts? What about home debts, automobile debts? Who takes preference? Well, the IRS really just obtains the same rights as any creditor. They don't jump ahead of anyone. They don't have any special preference. They're treated like any other creditor that you may have. The concept is that the IRS steps into your shoes when it comes to priority to being repaid. We'll discuss that concept in a bit. So let's start off with a discussion of liens in general. A lien is a claim against an asset, and this concept applies in many commercial transactions, not just debt collections with the IRS. It applies when it comes to home purchases, when it comes to auto purchases. When a lender advances money to buy specific assets, they typically take a lien against that asset. Now, to have effect, a lien has to be made public. So having a lien doesn't do a lot of good unless other people are aware of the lien and where they fall in terms of priority. The IRS initially obtains what's referred to as a silent lien. What happens is the tax is assessed, there is a bill if there's a payment due, a bill is sent out to the taxpayer. If there's no payment within 10 days, the IRS obtains a silent lien dating back to the date of assessment. Public notification. I mentioned a few minutes ago that the public does have to be notified of the debt in order for it to have priority over other debts. So the IRS uses what they refer to as a Notice of Federal Tax Lien. It's commonly called an NFTL. It's typically filed with agencies where the taxpayer lives. So that would be your local land records for real estate, your town hall, Secretary of State. It's really filed where borrowers typically search to determine liens that are against a taxpayer or their assets. The searches that are done are typically referred to as a UCC search, which is a Uniform Commercial Code. As mentioned, the IRS steps into your shoes. Whatever rights you have to an asset, either at the time of the tax debt or in the future, becomes the IRS right to that asset. Let's go through a quick example. You buy a house for $400,000, and in year one, you borrow $300,000 from a bank, and they record a lien against that property for their debt. Now, you own 100% of the house. The bank doesn't partially own that house. You own 100%, but the bank has a claim against the value of the house. Now, let's assume year two, you incur a tax debt of $500,000. Now, the question is, does the IRS have a claim in year two for all of your home equity? In other words, if the house is still worth $400,000, do they have a claim against that entire $400,000? The answer is no. The bank has that initial priority. They step in your shoes, which means they have a claim to anything beyond what the bank has a claim to. Now let's go forward to year three. There's an actual property sale for $450,000. Now, as mentioned, the bank will be paid their loan back, so $300,000, and there's an excess of $150,000. That would all go to the IRS. Now, of course, the IRS equity in any asset is limited to the amount of the tax debt. Now, let's continue on with our example. Would a buyer be willing to take the property? As mentioned, the sale would generate enough cash to pay off the first lender, but not enough to fully satisfy the IRS. You can think of the IRS lien as a blanket which covers over all of your assets. The IRS will allow you to essentially take an asset out from underneath the blanket, so in other words, release their lien, if they're given appropriate consideration. So in our situation, there was enough to pay off the entire first priority, and there was equity remaining after that. Now, we've discussed the concept that the IRS will allow, in certain circumstances, for an asset to be taken out from under the blanket. In other words, not subject to the lien. But in order to do that, you have to make a formal request to the IRS. You have to provide documentation that the IRS will receive what you otherwise would have received. So in other words, in our example, any equity that remains after the bank is paid. Now, that may or may not be enough to fully pay them, but as long as they receive as much as you would have received on a sale of the property, they typically will agree to allow the property to be sold free of the lien. The process is similar to releasing the bank with respect to their lien on the asset. In other words, it will be handled as a condition of closing in the real estate transaction. What about a refinancing? Will the IRS allow a property to be refinanced? Well, the issue here is that typically a lender would not come in after the IRS and loan money on the property, because the IRS would have a preference to the equity in the property, and in our case, if the IRS were paid off, there would be nothing left over in terms of equity for a lender to come in a refinancing transaction. So what happens is there is a concept called subordination. The IRS can choose to go behind the next lender in terms of priority. And you might be saying, why would they allow that to happen? Why would they allow someone to step ahead of them in terms of priority? The reason is the IRS will receive something in connection with agreeing to the subordination. Now, if it's a cash out mortgage, as long as they receive the cash towards the debt, again, limited to the amount of the debt, they typically will allow this to happen, but it's something you need to approach the IRS ahead of time, prove to them that they'll be receiving any cash that you otherwise would be entitled to. In the case of an interest rate reduction, there will be no immediate cash, but your expenses may decrease in the future. Assuming you pay to increase your monthly payment to the IRS, they'll typically allow for the subordination because that will enhance their position when it comes to getting paid. Quick conclusion and what's up next. The IRS doesn't use a lien as punishment to a taxpayer. The IRS lien is used to secure the IRS claim against your assets so that proceeds on a sale don't just walk away or disappear when it comes to the IRS. So the IRS wants cash. They don't want your property. The mechanism in place with the lien is to ensure that they receive cash on a sale, and again, they would prefer cash over owning the property. So that's it. Up next, we'll discuss payroll tax debts. Thanks for joining us, and feel free to reach out to us if you have any comments, questions, or need assistance. Thanks.